Today, we are going to reveal the key moves Warren Buffett is making to thrive during the upcoming recession and learn practical steps you can take to emulate his success. This could be a rare chance to seriously grow your money because things might be getting easier for those who know what they're doing. Recessions happen regularly, and if you play your cards right, you could be setting yourself up for life with some incredible deals. Even Warren Buffett says bad news can be your best buddy in investing.
Well, anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. But stocks are going to go down. You could probably look it up as to what percent of the days, since I was born, they've gone down, and maybe it'd be 30% or something like that. And you can't predict what stocks will do.
Stick around to uncover the secrets that could potentially transform your financial future and position you for prosperity, even in challenging economic times. At first, in the next 12 to 24 months, understanding the economic landscape is crucial. The potential for a recession brings challenges like more people out of work, lower wages, shaky consumer confidence, and a general decrease in value across various sectors. This impacts everything from stocks to everyday necessities like food and services, possibly on a global scale. Companies are feeling the effects with visible drops in earnings. Quarterly reports show a cautious outlook, scaling back forecasts in anticipation of slow or negative growth. This approach, not seen in 10 years, often leads to job cuts as businesses streamline operations due to lower consumer demand. For investors, the main focus is on the stock market. Right now, major indices are on a downward trend, showing declines of 20 to 30%. Analysts, including those at JP Morgan, predict a further 20% drop from current levels. Looking at data since 1946, the average downturn in bear markets is around 30%, with the worst instance in 2009 seeing a 50% fall in the S&P 500 from its peak. Combining the average market decline with the recession's impact, bear markets tend to be more pronounced, experiencing an average drop of 34.8%. The lowest point often aligns with investors' surrender, signaling the potential start of a recovery phase where markets bounce back. Moving on to the second important point, real estate. While regional variations exist, a noteworthy pattern emerges on a national scale. Significant declines in housing prices are infrequent. Over the past 6 decades, instances of prices falling by more than 10% have been rare. However, the current consensus on Wall Street predicts a 7% decline in national housing prices, with a worst-case scenario anticipating a 10% to 15% decrease should interest rates continue to rise. Of course, variations exist in every market, and according to Moody's Analytics, the more susceptible markets might witness a decline of up to 25% from their peak. This particularly affects regions like parts of Florida, Arizona, Idaho, and Southern California, with the decline projected to persist for another 12 to 18 months before reaching the bottom. On a broader scale, this might not significantly impact those with a fixed-rate mortgage planning to remain in their property for the next 5 to 10 years. However, for potential investors or homebuyers, opportunities could emerge as deals start appearing on the market, a point we'll delve into shortly. This leads us to the third consideration, cash. Traditionally, there's been a perception that cash loses value due to inflation. Yet when other assets are undergoing price declines, cash emerges as a secure option for wealth storage. The acknowledgement of this shift is notable, especially when figures like billionaire Ray Dalio concede that cash is no longer disregarded. In fact, as recently as 2018, cash proved to be the best performing asset. Merely saving money in a high-yield savings account would have surpassed market returns. Cash is now gaining prominence in portfolios, with fund managers holding the highest cash levels since 2001. Citigroup even suggests that cash stands as the only asset investors could utilize as a recession hedge. As for actionable steps to capitalize on this impending shift and why many miss out on such opportunities, consider the following. The upcoming recession could be a rare chance, akin to a once-in-a-generation opportunity, for several reasons. Firstly, everything becomes affordable. While some might view this as a bad time to invest due to a 30% market decline, the affluent see it as an opportunity to acquire the same assets at a 30% discount. Warren Buffett encapsulates this with a simple analogy. When hamburger prices go down, we sing. When hamburger prices go up, we weep. This principle holds true for most life purchases, except for stocks. When stocks decrease in value, offering more value for money, they become less favored by the general populace. So firstly, it's essential to shift your perspective because a declining market can present opportunities. Secondly, reduced competition becomes a notable factor. In challenging times, larger companies often retrench, conserve cash, and adopt a cautious stance. This creates openings for smaller, more assertive enterprises to distinguish themselves and fill the void. A study across 16,000 companies highlighted that those maintaining advertising efforts during difficult periods increased their value, experiencing positive growth even years after the recession concluded. Thirdly, a recession ushers in more opportunities. In a way, it serves as the market's mechanism for eliminating weaker entities. A wise investor drew an insightful analogy comparing the peak of the market cycle to a forest, where only the most significant, well-established trees or companies access all resources, akin to sunlight. Entities at the bottom struggle to compete and grow. Analogous to natural forest fires, economic downturns periodically clear out companies unable to sustain themselves, creating space for newer, smaller businesses to thrive. Fourthly, a bull market follows every bear market. As per historical data highlighted by Yahoo Finance, the S&P 500 typically falls an average of 29% during a recession, with a median drop of 24%. However, after hitting their low point, stocks demonstrated an average return of 40% the following year, and within 2 years, the market saw an average increase of 58%. Investing during the market decline tends to be more profitable than withdrawing and waiting. It's crucial to recognize that throughout history, the market has consistently rebounded in the long term. Lastly, the fifth point emphasizes the importance of acting before widespread awareness. While it might seem straightforward to consider investing during a recession, the reality is that recessions are officially confirmed much later. For instance, the Great Recession, commencing in December 2007, was only officially declared in December 2008, a few months before its end. The recession before that began in March 2001, but it wasn't labeled a recession until November of that year. Typically, there's a 6 to 12-month delay until the confirmation of a recession. In terms of actionable steps to capitalize on potential opportunities, the first involves scaling back expenses. This includes vigilant monitoring of the market, cutting unnecessary spending, and operating efficiently while reinvesting as much as possible back into the market. It also entails devising a plan in case of a 20 to 50% drop in income, considering how to compensate for the difference, and proactively taking measures to protect against such scenarios. Starting with the second point, maintaining a reserve of cash is crucial. While statistics may advocate for immediate investment, there's merit in having a portion of your portfolio in cash for peace of mind and a safety net. Personally, I allocate between 15 and 20% of my portfolio to cash, adapting based on the time of year. This strategy has provided numerous opportunities to seize favorable deals when they arise, offering a reassuring cushion for unforeseen circumstances. Moving on to the third point, safeguarding your career emerges as an important strategy. Ultimately, your career serves as the primary hedge against uncertainties. The worst-case scenario isn't solely the market downturn, but a simultaneous job loss, compelling you to sell investments at their lowest point before they have a chance to recover. Now is the opportune moment to enhance your skills, acquire new knowledge, and reinforce your current expertise, ensuring resilience in the face of economic fluctuations.
But the advice I would give is to read everything in sight, and to start very young. It's a huge advantage in almost any field to start young, and if that's where your interest lies, and you start young and you read a lot, you're going to do well. I mean, there are no secrets in this business that only the priesthood knows. I mean, we do not go into temples and.
Next, the fourth point advocates for a long-term investment approach. Continuity is key, and studies support the profitability of dollar-cost averaging, consistently investing in the markets over time. Staying invested and maintaining a regular buying pattern has proven to be a lucrative strategy. Amid market fluctuations, adhering to a long-term investment perspective can yield favorable outcomes. The fifth point emphasizes the importance of diversification in investments. If a 20% drop would induce panic, it signals an overly aggressive investment strategy. For instance, if your portfolio is solely comprised of U.S. tech stocks, consider incorporating large caps, international stocks, or exploring real estate investments. Diversification provides stability. The more legs your portfolio has, the less susceptible it is to collapse should one or two elements face setbacks. Doubling down on work, exploring side hustles, and acquiring knowledge are advised during this period. Today's efforts will reap rewards when the market rebounds. While it may not be an easy journey, persistence will undoubtedly be rewarding for those who endure the challenges. These strategies provide a solid game plan for navigating economic uncertainties without using fancy words or outdated language. First off, keeping some cash handy acts as a financial safety net, giving you a buffer when things get unpredictable. Career protection is a must, serving as a shield against the dual threats of job loss and market downturns. Taking the long view on investments promotes consistency, helping you ride out the ups and downs. Diversification is another key move, preventing you from going all in on specific risks that could backfire. By sticking to these straightforward principles, you position yourself to withstand economic storms and potentially come out ahead when the dust settles. If you want more down-to-earth investment tips, hit that subscribe button. Feel free to drop your questions or comments below. We're here to help. Happy investing, and may your financial journey be as smooth as possible.